Stocks gained some more despite mixed global cues as strong GST collections and recent Q4 earnings infused some confidence. Metals, IT and energy lead gains, FMCG and realty lag.
Even as Kotak Mahindra Bank posts record return on assets and margins in a strong Q4 performance, MD and CEO there Kotak says the bank is open to small acquisitions and not afraid of large acquisitions.
A slew of earnings and financials drive moves. M&M Finance and IDFC First Bank gain after beating street estimates, but RBL Bank slips on a lackluster show.
And auto sales for April was a mixed bag. While Eicher Motors and Bajaj Auto reported strong growth in domestic motorcycles, Hero and Tata Motors saw weakness in sales.
SEBI has asked for 6 more months from the Supreme Court to complete its probe into the Hindenburg allegations against Adani Group and to ascertain any foul play in trades of Adani stocks. The ball is now with the Supreme Court.
Okay. Well, good afternoon. Welcome to Halftime Report. I'm Sonia Shenoy and with me is Ekta Batra. Well, the market is looking good. It's had a strong start. It's building on to its gains, up about 90-odd points. The good part is that the momentum that we saw last week is something that's carried forward today as well. So the bulls are not giving up on their control just yet. And the mid-cap index, so the broader market is doing very well, an indication that the market breadth is healthy and the texture in the market is definitely improving. Now, what's leading the market from the front today is commodities. So Tata Steel, JSW Steel, Hindalco are all your top gainers. And then you have IT. So it would be interesting to see if IT comes back after a steep fall that we've seen in the last many months. Tech Mahindra, Infosys are all your big gainers today, up about 1 to 2% odd. And then, of course, we have stocks like Bajaj Auto at a 52-week high after reporting good auto sales. So the market actually has plenty to latch on to in terms of, the bulls today.
Hi, Sonia. Yes, absolutely. I think it's all news-driven, especially for the market as a whole. If you see the kind of gains that we built on from last week. Last week, we had one of the best weeks that we've seen in 9 months. The Fed meet continues to be in focus in terms of one of the big determinants or cues in this week's trade. But separately, you did mention a lot of stocks, but there are a lot of other stocks in focus. Hero Motorcorp, for example, is one of your top losers on the Nifty. Sales down around 5.2% on a year-on-year basis. Kotak, that one came out with a very good set of numbers. There were a lot of performance on parameters which it excelled in this quarter, but possibly the valuations are weighing a little bit. Its plans on M&A is probably weighing down on the street at this point in time. Ultratech Cement also a bit sluggish despite its numbers, in fact, coming in fairly in line or above estimates as well. So that's what's taking place in terms of the market. A lot of results to watch out for today as well. We have Ambuja Cement, Tata Steel, all of these numbers which will be coming out. But let's talk about one particular company that did deliver its numbers over the long weekend. It was a weak performance from RPG Life Sciences in Q4 on a sequential basis. The margins came in at around 13%, while revenue and profit also witnessed a slowdown. Although on a year-on-year basis, the revenue growth was steady, profit also was strong. Domestic formulations has been and is the biggest contributor to the business with around over 50% of sales. Yugal Sikri, the MD at RPG Life Sciences, joins in now to discuss their Q4 performance. Hi, Mr. Sikri, welcome to the show. I wanted to start by talking about the margin pressure that you all saw this quarter. If you compare it on a sequential basis, the margins have come off and it's flat on a year-on-year basis. You have mentioned in your press release that there was some pressures with regards to geopolitics on the supply chain. Can you tell us what you all went through this quarter?
Okay, thank you so much again for getting me on your channel. With respect to Q4 performance, I think if we look at from overall perspective, we have registered a double-digit growth ahead of market. 14.2% is our growth on revenues. In terms of the profits, also we have registered 20% growth in EBITDA, 26% growth in PBT, 38% growth in the PAT. Margins have improved in all PBT, EBITDA, PBT, PAT, all of that has improved. QOQ, which you talked about, yes, the performance has been lesser. But let me point out to you that in our business, any year, if you see earlier 2 years also, QOQ is always lower in Q4 because of the product mix, because of the seasonality, because of the customers' order placing pattern. All of that makes Q4 to be lesser than the Q3. This has been the case all throughout. Otherwise, I think on all parameters, I talked about revenue, profits. Let me also talk about cash surplus. We have generated record cash surplus. In fact, this year has been a milestone year for us. We have crossed 500 crore plus in revenues. We have crossed EBITDA 100 crore plus. Our cash surplus has gone up by is beyond 100 crore plus. Our net working capital is the lowest, lifetime lowest. Every single parameter. I think the performance continues to be in the line the way it has been for the last 4 years.
Sure. Mr. Sikri, I got that. So there is seasonality involved this time around, but your margins have improved from that 9-10% level that you used to clock in way back in FY19. Your margins are now at 13%. Are there more levers to grow your margins in the near future? And what do you think FY24 and FY25 could look like on the operational front?
Yeah, if you recall my commentary on the margin front, our margin improvement is structural. And those margin improvement, when I say it is structural, it is driven by certain fundamental changes which we have done. For example, we have org structure optimization we have done. We have done the efficiency improvement. We have controlled the P&L leakages. I think all of that will continue to behave the way they have behaved. Margin improvement would happen basis the product mix. We are focusing on launching products which are more profitable. We are focusing on highly profitable legacy product businesses. We are doing life cycle management for those products, which is showing good traction to us and which is contributing to our domestic formulation business higher. And all of that put together would contribute to the margins the way it has been happening in the last 4 years.
Okay, all right. So that's on margins. There is a bit of seasonality which comes through. But will you revert back to that 20% level next quarter? That's my first question. And the second part of this question is if you could just break up what this 14% revenue growth comprised of. How much of it was from the domestic market? How much of it was from exports? So one, when do you revert back to those 20% levels in terms of margins? And two, the breakup in terms of growth this time.
Okay. So, can you just repeat your first question?
Margins. When do you revert back to those 20% levels, which you have been clocking for the previous 3 quarters?
Yeah, I'm pretty optimistic that we will revert back for the reasons I just mentioned, the structural part. The seasonality is good in Q1 and Q2 and Q3 going forward. So I don't see any reason why the margin should not come back to what we have been recording so far. Regarding the breakup of the 3 businesses, and so domestic formulation contributes about 65% to the sales, international formulation contribute 18% to the sales, and both of these businesses put together in Q1 have registered 21% growth. And it's the API business where we had some kind of the inventory adjustment at the customer end, because of which the API business has shown some kind of a down this quarter. But I'm pretty optimistic that next year it will come back because the ordering pattern of the customer will take care.
Okay. Can you also tell us a little bit about the scale-up plans that you have in the US markets? What is the plan over there and what would the outlook be for FY24?
Yeah. Thank you for bringing that out. On the international business front, our focus is very clearly well defined. we are focusing on the regulated markets like EU, UK, Australia, Canada. And some of the select EU markets. And on the ROW side, we are focusing on Myanmar, we are focusing on certain South Asian markets like Vietnam, Philippines, etc. So that's the focus which will continue going forward. On the product mix side also, we have defined clearly the three categories of the products which give us sustainable, profitable business in the regulated markets will continue. In case of the ROW markets, our focus will be on select therapies. So all of that put together will drive our performance. On the international business side, we have been registering very healthy EBITDA margins in the international formulation business, thanks to our strategy of focus on identified therapies and identified product categories, which is likely to continue. I also want to take the opportunity to share with you that international formulation business is emerging yet another growth driver for us because of our investments of huge capex on both the plants, API plant and the finished formulation plant, which I think should be over by the end of this fiscal.
Sure.
And we are also working on the R&D pipeline, both on API and the formulation, basis which international business should emerge as a strong growth driver.
Sure, sir. What about, the two plants which have had a warning letter since 2013 by the US drug regulator? Has the remediation been complete? Are you looking for them to probably come and even re-inspect the plant? Or you're not looking at the US anymore?
Yeah, US would be is in our list, but US comes the last. However, both the plants which are under current modernization as well as capacity expansion would be in a position to take the approval of best of the regulator, which includes US FDA. Regarding the remediation measures which you talked about, remediation measures we have already taken in case of the Ankleshwar plant, which is the formulation plant. API plant, the modernization exercise, thanks to modernization exercise which has started now, we should be through with those remediation measures by the end of this fiscal.
Okay, just before, this is the last question from my end, I just wanted to understand your cash on books, Mr. Sikri, and how you would be utilizing the cash, considering that you have such a strong focus on the domestic market. There are a lot of deals which have taken place in the domestic market. Say it's individual drugs, portfolio of drugs, or maybe even company stake. Any such deployment of cash that RPG would be considering, one, and if you could just apprise us of your cash on books.
Okay. First, we have been recording cash addition year after year. This time, it's a record surplus of 115 crore or so. And regarding the utilization, I think we have clearly identified M&A as an area where we are working on. We are looking at the brands acquisition, we are looking at the company acquisition. It's only that we should get the right candidate which fits into our listed down requirements. So the cash is going to be used for the business expansion. Second, I just mentioned earlier that the business, there is good amount of capex being spent on modernization of the plants and capacity expansion. Will help us to generate business going forward in the international markets.
All right, Mr. Sikri, we'll leave it at that. Thanks a lot for joining in and speaking to CNBC-TV18. That is the Managing Director at RPG Life Sciences talking about their Q4 performance. Let's do one thing. Let's get our focus back on the markets, but that happens in some time from now. We'll take a quick commercial break and be back with lots more. Stay tuned.
Welcome back. Well, let's talk about auto sales then. Maruti reported what was a mixed set of auto sales for the month of April. Domestic sales witnessed a growth of around 8.5%, while exports slipped by nearly around 8%. Sonia, in fact, did catch up with the company's senior executive officer, marketing and sales, Shashank Srivastav, and started by asking him about their retail numbers and the demand situation.
Retail was a little muted, I would say. Because even if you look at the overall industry, the wholesale numbers grew healthy 13%. Maruti Suzuki's passenger vehicle domestic numbers grew about 12%. So overall in the industry, 331,000 sale against 294,000 of last year. However, on the retail side, we saw a little muted because, the overall retail was only 285,000 against about 276,000 of last year, so flattish numbers there. And this difference between wholesale and retail obviously adds up into the dealer inventory. So the dealer inventory for the industry has gone up to about 254,000 units, up from 200,000 that it was at the beginning of the month. And after a long time, we see that this three and a half week of inventory, which is sort of a normal inventory, and therefore we have to carefully watch how the situation goes from here.
Okay, so you're saying that retail sales were a bit muted for the industry at 285,000 and you need to watch the situation carefully. So what kind of domestic growth are you looking at? Do you think this single digit 7 to 8% growth that we've clocked in for Maruti itself is something that can continue in the next couple of months as well? Or given, how high the inventory is and the muted growth situation, do you think it could be slower than that in the upcoming months?
So we haven't really revised our estimates for the industry. Still remains at 5 to 7% growth. So roughly 4.05 to 4.1 million is the projection still. And Maruti Suzuki, we expect the growth higher than the industry, largely because of the new SUV models that we have introduced, the Fronx and the Jimny, and also that for the full year, we will have the effect of the Grand Vitara, which last year we had introduced only 6 months before the financial end. That was in September 2022 that we introduced the Grand Vitara. So we are expecting to grow faster than the industry, and we haven't really changed those projections at the moment. Yes, in the month of April, we had been affected because of the semiconductor component issue. That obviously is something which we are still battling with, especially for many of our models which have got long waiting periods. Q1, I suppose, we will continue to see that effect of semiconductor short supply as far as components are concerned.
In the quarter gone by, there were some price hikes undertaken due to which the realizations went up as well. Any more price hikes on the anvil, or do you think it would be hard to undertake price hikes given how sticky the demand situation is? Really the price hikes and price changes depend on the movement of commodity prices, because that affects the material cost, which affects the component cost, and component cost is roughly 75-77% of the overall auto OEM's cost structure. So you are right. In January, we took the price increases. Also in April, by the way, most of the OEMs did in response to the BS6 Phase 2 norms and the OBD2 norms that kicked in from 1st April. Going forward, difficult for me to predict, because while the commodity prices have sort of softened a little bit in the last few weeks, especially when you look at copper or aluminium or the rare earths, but the steel has gone up 6-7 rupees, expected to go up a little bit further. So I think we are very closely monitoring the situation to see how much is the cost structure changing. It will largely depend on the movement of the commodity prices. All right. Exports have been under pressure this time, almost an 8% fall year-on-year in wholesales. How were retails? Was it as weak? And also, do you expect the weakness in exports to continue? If yes, which are the markets that are still a bit under pressure?
Actually, the export numbers that is reported as shipment figures. Actual sales happen, after the ship reaches the destination, and then it goes to the distributor, and then to the dealers, and finally to the consumers. Normally, there is a 3-month lag. So these number differences, which you are saying, largely the ship scheduling differences, not too much to be read into it. On an overall basis, if you see Maruti Suzuki's export number 259,000 last year, we expect export number this year to go up from this 259,000. So we are still saying that there is going to be a growth in the export market. Of course, the top continents where we export are Africa. We have Africa, Latin America, ASEAN, and Middle East. Top countries, if you drill down, actually have been for last year, for example, been Saudi Arabia, Chile, South Africa, Ivory Coast, and so on. We expect that the demand to be continue to be robust on the export front this year as well.
Okay, so demand will be robust on the export front, and you're expecting a growth. So for the industry as well as for Maruti, what kind of export growth are we looking at? Overall growth, you said, would be 5 to 7% for the passenger vehicle industry. But break it up for us in terms of what domestic growth would be and where would exports feature?
So export growth for the other manufacturers is difficult because there's no estimate of export projections. We were around the 6 lakh overall export for the passenger vehicles from India last year, and I would expect it to go up this year. However, and unlike domestic, there is no real projection because every manufacturer, depending on his capacities, follow a different strategy for export. So I can only say that from a Maruti perspective, we see a growth. And also from an overall number in the industry, I would expect a growth in exports as well.
Okay, so that's the management of Maruti. The stock is up around 2% and it is steady for the markets as well. The mid-cap index is currently up around 1%. We have a good advance decline ratio on our hands, which is on the positive side. Some numbers coming in. Nugent Software, where the stock is reacting very handsomely to its numbers. Revenue up around 19% on a sequential basis, and the profitability should come up for you as well. It just about went fleeting by over 60% in terms of growth on a Q-on-Q basis for Nugent Software. Time for a short break now, but up next we'll get talking technical. Stay tuned.
Welcome back to Halftime Report on CNBC-TV18. Well, the market is still going very strong. So let's give you a quick update on what's happening. It's 90 points higher now for the Nifty. It hasn't moved. The needle hasn't moved through the course of the day. It's been stable as she goes for the first couple of hours. Sachidanand Uttekar of Trade Bulls is joining us on the show to tell us how to approach the rest of the day and the week. Sachidanand, are you getting a sense that this market has more legs on the upside? You know, there are plenty of positives that we're dealing with, but do you think that, there could be incremental moves on the Nifty? And what are the individual stocks to look at now?
Good afternoon, Ekta. Good afternoon, Sonia. I think clearly from the last week's data, we are confident that this particular rally should continue towards 18,300. And probably, we may see one more fresh leg towards 18,500. If you look at, both the indices, be it Nifty or Bank Nifty, there are no signs of any exhaustion, despite of the fact that we've seen a continuous rally for almost 7 trading sessions in a row. So I think, one needs to understand that until unless we don't see any, decline below its 5-day exponential moving average, I think the trend and the momentum should stay intact. We're expecting this particular momentum to hold until unless Nifty does not drift below 18,060 mark. So the immediate level that we are tracking on the upside is around 18,340, which could be seen or witnessed during this particular week itself. And that's why we continue to build long positions. And this is what we are recommending to our clients as well. So 2 stock ideas from our end. Today, metals are holding out well. If you look at Tata Steel, there's a good evidence of a inverse head and shoulder breakout on its daily scale. It has managed to sustain above its 200-day exponential moving average, which was placed around 109. The pattern is indicating a price target somewhere close to 125. So from a position perspective, it's a good level to get into this particular counter. From a momentum perspective, the stop loss can be placed at around 108.50. The immediate target could be around 117. But we see a positional potential till 125. So this particular stock can be, taken on the long side. The second stock which has been on our radar is Maruti. There's a good short covering rally which has triggered about the 8,700 mark. If you look at the formation, it's a cup and handle formation on the daily scale. The immediate target that we are looking at is close to around 9,000. So the same can be participated with a stop loss somewhere close to around 87.20.
Okay. Well, one stock which is doing very well is Nugent Software. We just pointed out that it was up 5% post numbers. Now it's jumped to a double-digit gain of around 11% on in terms of a stock performance. It's been a stellar performance which has come through on all parameters for Nugent. It's not only the revenue as well as the profitability, but it's the EBITDA which has also managed to spike up. So good going coming in for Nugent Software. Well, Sachi, I just wanted to touch upon that particular parameter, the broader market stocks, because the mid-cap index itself has outperformed as compared to the frontliners. So are you looking at more stocks within the broader markets which look probably more technically attractive as compared to the frontliners at this point?
Well, if you look at some of the PSU stocks, I think the focus was there last week, and we still continue our long bias when it comes to PSU stocks, especially. One stock that has been on our radar is Canara Bank. If you look at the entire structure, we have seen a fresh breakout from a falling wedge formation, which was established last week. And if you look at the weekly RSI, it is comfortably trending above that 57, 58 mark. So there is no sign of exhaustion here, and probably, this particular move can also continue towards 340 on a positional basis. And that's why we have also recommended this particular stock to our clients. From a trading perspective, I think the stop loss can be placed somewhere close to around 315 from here on. And we see this potential of PSUs, the entire sector, the entire pack to continue its momentum. So even when it comes to a stock like Reliance, which was consolidating, in the previous series, has witnessed a very strong breakout. So probably, I think it will be an overall rally wherein the large caps have already performed, and the outperformance of the broader market should continue.
Okay, Sachidanand, we'll leave it at that. Thanks a lot for joining in. Let's slip into a quick break. On the other side, we'll connect with Yogesh Malhotra, the whole-time director and CEO at Gravita India, to discuss their Q4 numbers. Welcome back. As promised, we have the management of Gravita India. It's a corporate on our show today. It was a steady performance from the company in Q4. The company recorded a healthy growth in revenues and EBITDA, while profits also surged in double digits. Last month, the company enhanced the lead recycling capacity at Mundra by 40,500 million tons per annum to 60,000. Yogesh Malhotra, whole-time director and CEO at Gravita India, joins in now to give us, a view on how the business is shaping up. Yogesh, thanks a lot for joining in. I want to understand this 40,500 MTPA capacity ramp-up that you're looking at. Can you tell us what are the peak utilization levels and what does this mean in terms, once the ramp-up happens in its entirety, what does this mean for a revenue scale-up as well?
So with this capacity now, addition in capacity, now our total capacity on a consolidated basis, including India business and overseas business, is around 2.5 lakh metric ton per annum. We generally get 8 to 10 times revenue from the capex that we do. So if you look at the overall capacities, I think we are in line to do around 25% growth year on year for the next 3 years, 3 to 4 years. And we would increase the capacities further also from this 2.5 lakh tons per annum. In the next 3 years, we would do capex to improve it to around 4.25 lakh metric ton per annum in the next 3 years.
Okay, so this I assume is a part of your Vision 2027?
Yeah, 2026, 27, yes.
Okay, so what are the other parameters which comprise of Vision 2027? If you have to tell us how much you would probably get in terms of total volumes, how much are you going to generate, say, from the overseas markets, as well as from segments such as value-added products? What is your aim?
So the aim is to grow at around 25% in revenue terms.
Okay. So I think we've lost that connection. But nonetheless, they do have a Vision 2027. If you're just talking about the quarterly highlights, it was 11% volume growth, 12% revenue growth. We have Yogesh back with us. So Yogesh, if you could just apprise us of what numbers we can expect by 2027 for the P&L for the company.
So, as I mentioned earlier also, you can expect a volume growth of 25%. Revenue numbers would change depending on the prices of the commodities that we deal into. But overall, 25% growth rate in volume terms year on year, you can expect from the business going forward. And when I talk about 25% volume growth, it is from the existing businesses that we are into. That is of lead, aluminium, plastic, and rubber recycling. But we are also planning to put up new verticals of lithium-ion battery recycling, steel recycling, and paper recycling going forward in the next 3 years.
Okay.
So we would be spending around...
Sure. Please go ahead. You will be spending around
250 to 300 crore rupees in these new verticals, in addition to the capacity increases in the existing verticals.
And what does this mean in terms of the EBITDA per ton? What is the guidance that you would be putting out for FY24?
So EBITDA per ton would remain around 9 to 10%, which is currently the levels at which we are doing it. But you can expect some upside, basically because of economies of scale and because of increase in the contents of value-added products, and also some improved efficiencies going forward. But I would like to add on here that because we are operating across geographies in different product lines, and also the models are also different, because on one line we are importing some products into India, processing it and then exporting it outside. But at the same time, another model is basically tolling business, which is also increasing a lot. So apart from EBITDA margins, we are also focused on the ROC from any business, whether it is existing or new. And we have our own benchmark of around 25% ROC from these businesses.
Okay, yes. So that's 25% ROC. That's your aim basically from these new verticals. But I just wanted to ask you for some more numbers from these new verticals. If we have to talk about the business contribution from these various verticals in 2027, from your existing as well as your new businesses, how much would it be? And what would the blended margins be according to you?
So same blended margins would be around 9 to 10%, as I mentioned earlier. The EBITDA margins would continue to remain in the same lines. You can expect certain increase, and in terms of revenues, if you talk about, as I mentioned, that we will be spending around 250 to 300 crores in the new verticals. So you can expect around 8 times revenue from these verticals. Based on the capex that we spend on. So around 2,000 crore rupees of additional volumes revenue can come from these verticals.
And that is by when?
By 26-27.
By 26-27, 2,000 crores of additional revenues can come in across these verticals. All right.
From new verticals.
From the new verticals. Okay. Can you tell us what is the updated debt on the books? Has it risen in the recent past, and what's the way forward?
So we are very comfortable on the debt position. It's currently at around 350 crores. And we have our internal benchmark of keeping debt equity ratio of 0.75. Currently, it is at around 0.58. Similarly, the debt EBITDA ratio also we have fixed at around 1.5x. Currently, it's at 1.2x. So it's very comfortable position as far as debt is concerned.
Okay, all right, Mr. Malhotra, we're going to leave it on that note. Thanks very much for joining in and speaking to us. So that's Gravita India. That stock is up around 7-10%, but they do have a strong guidance by 2027. They do want to get into new verticals. They're targeting a return on capital employed of around 25% from these new business verticals in the next 3 to 4 years. Time for a short break now, but more on the markets. Lots of stocks in focus, especially on account of earnings. All that and more on the other side. Stay tuned. Welcome back. Well, it is steady for the markets, but there is one particular stock which has really perplexed investors in terms of the kind of returns we've seen. RVNL is the one that I'm talking about. To put things into perspective, it's not just gained only 71% odd this year, but if you look at it, it listed in April of 2019 and its issue price as well as listing price was 19 rupees. It hit the markets with its IPO with a price band of between 17 to 19 rupees, and just look at where that stock is today. So you've seen a multi-bagger return come through for RVNL, and it continues to surge in trade. Today, it's in focus after a big order win, also because it received Navratna status last week. Vivek is here with the details on all that and more, which is driving RVNL.
Well, absolutely. So RVNL has been the stock in focus for the past few trading weeks. In fact, especially given the strong up move the stock has seen in the last couple of trading sessions. So first, let's have a look at the news flow itself that's come in. So, it's another prestigious order win that the company has got. So RVNL in a JV along with SCC has emerged as the lowest bidder. And this is for an EPC project that is worth almost 2,250 crore. Now, the RVNL share in the JV is at around 51%. Now, along with that, recently there has been some positive news flow that's come in. So the Department of Public Enterprises has gone ahead and upgraded RVNL status to a Navratna CPSE, that's a Navratna Central Public Sector Enterprise. Now, what does this mean? Once you become a Navratna, you actually have increased ease of operations and increased independence of operations as far as capex as also as far as investing into newer projects is concerned. So now the company can go ahead and invest up to 1,000 crore independently without the central government approval, and the company also can go ahead and form JVs and enter into partnerships abroad as well. So that gives it increased scope as far as revenue visibility is concerned. Now, when you're talking about RVNL itself, one of the biggest triggers has been the kind of capex that the railway ministry has seen, and the company emerging as the lowest bidder, for the recent Vande Bharat train ordering also has acted as a key catalyst as far as the stock price is concerned. What does the company do? The company is an infrastructure project execution company, largely an EPC company, and which is why, given the strong ordering activity that you've seen, the stock has seen a complete re-rating. As you mentioned, just talking about the stock move, stock up 250% in the last year. That is, the stock has gone up 3.5 times just in the last 1 year.
Okay, thanks a lot for that. That's RVNL stock at a lifetime high. But IOL Chemicals and RT Drugs are also trading in the green right now after reporting a good set of Q4 numbers. Ekta, tell us more.
Well, yes, these numbers came out over the weekend, and both of them have seen a margin improvement. So that's the commonality between both of these stocks. I'll start with IOL Chemicals. The revenue is up 3% year on year, but the EBITDA has come in at around 95 crores, which compares to 45 crores on a year on year basis, with the margins jumping to a 7-quarter high at 16% versus 8% year on year. Profit is coming at 65 crores versus 29.76 crores. So they've been, very weak in terms of the margin front, and they've really outperformed or recovered when it comes to margins this quarter. Now, segment-wise, the chemical segment, the revenue was down around 11% on a year-on-year basis, but the EBIT has improved all the way to around 11 crores versus a loss of around 5.6 crores same time last quarter, and versus a 1.5 crore loss last quarter. So there has been an improvement both year-on-year as well as Q-on-Q. Pharmaceuticals, they've improved on a year-on-year basis in terms of revenue as well as margins, which have jumped up to 21% versus 13.4% year-on-year and versus 11.5% last quarter. RT Drugs, same story. The margins have come in at a 4-quarter high. Revenue is up 7%. EBITDA has come in up 8.8%. Margins have improved to 12.6% versus 12.4% year-on-year, and profit 55 crores. But the real improvement has come in Q-on-Q when it comes to operating margins. Margins 12.6 versus 10.6%. Profit has come in at 55 crores versus around 36.6 crores. So as you can see, multi-quarter high, both in terms of RT Drugs as well as IOL Chemicals when it's come to margins. And that's the reason why you've seen a surge come in or an upside come in for both of these counters.
Okay. By the way, some of these auto stocks are doing pretty well on the back of their numbers. Bajaj Auto reported it's hit a 52-week high after reporting very strong domestic sales growth in April. A growth of almost 109% year-on-year in the domestic sales. And exports were under pressure, but domestic growth has picked up in a big way. Let's slip into a quick break on that note. On the other side of the break, Manisha Gupta joins in. She has with her Ajay Kedia, who's the director at Kedia Advisory. Stay tuned. Welcome back to Halftime Report on CNBC-TV18. Just want to point out a couple of stocks. The market is not giving up its gains or anything, but there are some stocks that are bucking the trend and not participating. So wanted to point out, RBL Bank after its numbers is down 3.5%, and the stock has actually had a pretty rough year. It's already lost 15% of its value. So that stock's not looking good. Hero MotoCorp, similar case over there. Weak numbers in the month of April, and the street doesn't like that, down 2.5%. But Manisha Gupta is with us. She will give us a roundup of all the commodity and currency market action. Manisha, over to you.
Thank you so much for that, Sonia. Well, I have a guest joining me as well. Ajay Kedia from Kedia Commodities joins us now on the channel. Ajay, I want to talk about the spices. I mean, this is something that we don't do very often, but this is a time when you have all of these spices absolutely red hot. I mean, I know we keep looking around for investments and multi-baggers and etc. But take a look at the cumin or the jeera prices, where we are trading 3.5% on the higher side today. In the year 2023, we've seen prices gain up by 45%. And when you look at the last 6 months, the chart shows 85% of gains as well. While we do understand that the fundamentals are on the stronger side, but this clearly seems to be making headlines too sharp to ignore now.
Yeah, sure, Manisha, definitely. Whenever we talk about the investing, we generally have an idea about equity market. But frankly, in last couple of years, we have seen many commodity has given a double-digit return. Not only a double-digit return, but agri commodity like jeera, which has rallied more than 100% in last one year period. Fundamentals are very much supportive. As we know, basically India exports 80-85% of spices throughout the world, and last couple of years we were having a very low inventory, or we can say carryover stock was quite low, and this year it was expected that the area could increase, but as per the FI's last data in a release in the month of March, that clearly shows 70 lakh bag was the approximately the production size. But due to the unseasonal rain what we have faced in the month of March has downgraded the yields, and now also if you see in last couple of days there was some uncertainty in rain in Gujarat, Rajasthan belt. So overall yield were down, production were down. Demand post-pandemic from HoReCa industry was quite good. In India, marriages season or auspicious days like the Akshaya Tritiya and festive seasons are in front of us. All this was a perfect blend to gain any commodity like jeera, because since last couple of years, carryover stock was very minimal, and international participation from Syria and Turkey was not up to the mark. And China just opened up, because China is one of the biggest buyer for cumin from India, and China post-COVID has been now coming up with a huge buying. So all this factor has supported jeera prices. No doubt, technically we are slightly cautious at current level. Whatever drop, if we get, would be the good level to buy. But I think the fundamental rally should continue for next couple of years, next couple of months.
Okay. Ajay, clearly, the first question that I have is about the prices itself, and what a strong run-up we've seen. At these levels also, do you see buyers coming into the market, or do you see a lot of froth into the space as well? As in, do you look at a lot of speculative positions also now being accumulated at these current levels? And would you be cautious? What kind of upsides are you seeing from here, and what should be a near-term or a positional call now coming in for this one?
Definitely, Manisha, should be cautious at this current moment, because when the prices was around 25,000, it was clear-cut that fundamentals are very much supportive and speculative buying or whatever, because speculation will come when fundamentals and technicals or fundamental and prices doesn't match. So I think fundamentals are still very much supportive. As we know, our production, our harvest comes in the month of February and March, and still we have long around 10 to 11 months are left for new production or new production. So I think fundamentals are very much supportive, but currently around 45,000 is slightly overbought zone. So maybe a pullback toward 38, 39,000 would be a greater level to re-enter. But I think one should not take any kind of short position, should wait for a drop. Prices can go up to 48, 49 or even 50,000.
Oh, well, absolutely. Last year's crop was 7.2 lakh tons, which was in any case lower year-on-year basis. So the carry forward stock wasn't there. And this year crop estimates are coming at just about 5 lakh tons. So clearly much on the lower side, and that clearly has been supportive for prices. Ajay, you also mentioned the weather concerns going forward, and that is something that's keeping the other prices on the higher side as well. So within the spices sector, which you said we export 80 to 85% of, whether it's coriander, turmeric, isabgol, we've seen prices raise across sector. What's your sense for many of these as we get into the monsoon months?
Definitely, it's a balance for spices because one side turmeric and dhania is not at all moving because of carryover stock or production size what we are having. Last year we have got a very good import in case of coriander also. But on the other side, isabgol, which has been traded on NCDX now only, and we have seen prices has moved very sharply, just like what we have seen in Jeera also. So I think fundamentals are very much supportive for isabgol also. Again, a concern because in a very short duration prices has rallied, but fundamentals are very supportive, can test around 26,000 plus. And El Nino would definitely impact our new season sowing. That has to be witnessed again a rally. So overall, we can say the fundamentals are very much supportive for spices right now, particularly for Jeera and isabgol. Dhania and turmeric would definitely join the rally later on, but now it's time for Jeera and isabgol.
All right. Okay. Well, thanks a lot for joining in, both of you. And thanks, Manisha, as well, for taking this discussion forward. With that, it is curtains down on Halftime Report. Thanks for tuning in. The market is still in pole position right now, 100 points higher on the Nifty, doing pretty well. The mid-cap index is up 329 points. So don't go anywhere. There's so much action in the market this morning, led largely by the bulls charging away. So more on that coming up on the other side of the break. Stay tuned.